The following is brought to you by GoldSeekMint.com. Silver and gold bullion directly from the mint. GoldSeekMint.com.
Welcome to Cambridge House Live. I'm Vanessa Collette here at the Canadian Investor Conference, Vancouver. I'm joined by Chris Berry, President of House Mountain Partners. Welcome, Chris. Nice to see you again.
Nice to see you too.
Chris, what's your overall impression of the state of the junior market right now?
Well, I'm sure you're asking a lot of people that question, and there's not a lot of value that I could add in terms of a unique response. It's been a real challenging time. I mean, I've heard it referred to as a bloodbath over the last couple of years. I honestly expect that to continue for the next 12 to 18 to 24 months, and the reason is you're dealing with a global economy that's still trying to find its footing. The emerging markets, of course, led by China, are slowing down, and again, I'll take a 7% growth rate in China any day, relative, regardless of what it was, but the US and the Eurozone are sort of struggling to find direction, and that's compounded by the emerging markets slowing down generally, and that of course has a direct, I think, negative implication for commodity demand, at least in the near term.
Now, just specific to the junior resource sector, are you seeing any signs of recovery?
Well, I think you've started to see a lot more cost discipline out there. I think that some of the numbers of companies, in particular with some of the niche metals that I focus on, the sizes of those industries are starting to shrink somewhat. I think that's a good sign. There is a little bit of money that's getting raised out there. I just think that the name of the game right now, rather than worrying about drilling or drill holes or drill results, the name of the game is just to focus on sustainability and to stay alive. And so the juniors that I'm most interested in either have the strong balance sheets from a financial perspective, or have some sort of a sustainable or competitive advantage relative to their competitors that they can leverage to push forward.
Now, moving over to China, there's been a lot of concern about slowing growth, despite the 7.5% target that they have, just related to how it affects metal prices. How separate are metal prices from China today, would you say?
Well, I think that's a good question, and I think every metal needs to be viewed differently in that context. For example, my numbers may not be exact on this, but China is responsible for 40% of global copper demand and consumption. So, we saw copper fall from, let's just say, $4 down to $3, and now it's at about $3.15, and it seems to have leveled off. So if China is the largest consumer of copper in the world, and you see the price of copper sort of levitate or be range bound, my sense is that the growth rates in China are bottoming out. And I'd be the first to admit that you might want to take some of the Chinese growth statistics with a grain of salt. But generally speaking, when you look at the consumption patterns in that country, they're still very healthy. And so, I don't expect to see a lot of the base metals in particular go much lower at all based on what's happening in China.
Now, you've pointed out that emerging markets seem to be bouncing back a bit. Where does growth stand, and how is it affecting the resource markets?
Well, it's, it's definitely lower than it was, say, 3 or 4 years ago. You had China at 10%, India at 8%. I think the most recent GDP print in India was 4.8%. Russia has fallen off of a cliff. This to me implies a subdued demand scenario or profile for natural resources out over the next couple of years. I think you want to look at the excesses that I see in the global economy. For example, an excess of labor. We talk a lot about the growing middle class in China and India, and this idea of convergence of lifestyles. That is still valid and still makes sense, but the average emerging market citizen has to be able to earn, a wage to participate in the global economy. So there are a number of imbalances, again, in countries like China, India, Indonesia. The long-term demand profile and the story, if you will, is still very much intact, but it's very uncertain right now, and I expect it to stay that way for the next 12 to 18 to 24 months.
And moving over to energy metals, you've been following them for a while, keeping a close eye on them. What's driving the price there right now?
Well, right now, Elon Musk is driving the price, and I say that only half joking. You know, his Giga Factory announcement for Tesla is revolutionary, and it's revolutionary in the sense that if he is going to produce a factory, I don't care where it is, in the western United States or anywhere in the world, if he is going to build this $5 billion factory that by 2020 will be producing the same number of lithium-ion batteries that's produced globally today, you're going to need a lot more lithium, a lot more graphite, a lot more of everything. And so, you know, I'm not going to bet against Mr. Musk, who's been successful in a number of different industries, but I think the plans are ambitious, and back to your original point, that's what's really breathed life into a number of junior stories in particular. For example, lithium, the graphite plays, even some cobalt plays are all of a sudden much more interesting to investors based on Elon Musk pronouncements.
All coming from this Giga Factory.
You know, that's my general take. I mean, some of these lithium juniors, quite frankly, were in real trouble from a share price perspective. And, you know, he made the pronouncement and talked about how it's going to be in the located somewhere in the western United States. And so these North American deposits, again, of lithium and graphite and even some of the rare earth plays kind of caught a tailwind there. Look, it's an audacious plan. If you can get it financed, I think it's going to be really interesting. I mean, anyone that's ever driven a Model S or used any of his products knows that that technology is certainly commercially viable. It just seems like it's pretty aggressive at this point in time.
I think you can test drive them up on Robson Street.
Oh yeah? You can test drive them in Brooklyn, New York too, just as an FYI to your watchers.
Now, which of these energy metals do you think is poised to make the biggest gains?
Well, I think actually one of the ones that I'm most focused on right now is scandium, and that is a metal that is widely considered to be a rare earth element. It shares a lot of the similar properties, but it's not near the lanthanides, for example, on the periodic table. You know, scandium has a number of different uses. First of all, when you look at supply and demand, and that's one of the things that I think is most important with everybody watching, you want to look at each energy metal individually. So lumping lithium and scandium and graphite under the same umbrella and, you know, saying it's a great opportunity or a terrible opportunity, you're sort of missing the point. And one of the reasons why I like scandium as much as I do is because there's very limited supply. It's about 15 tons per year. That's 1.5, not 150 or 15,000. And the demand really hinges on the aerospace industry, because you can alloy it with aluminum, and also the solid oxide fuel cell business. And the fuel cell business is growing at, you know, very sound double-digit rates per year. So, you know, there's a lot of detail that we can get into about it, but scandium is a metal that if a reliable source can come online, and right now there are no reliable sources, you will see some of these other ancillary industries like the fuel cell business absolutely rocket to the moon, for lack of a better phrase.
Now, talking about uranium prices, we've seen that the prices have continued to drag since Japan hasn't restarted the reactors. What do you think could trigger them restarting the reactors there?
Well, two things. Obviously, what do I think will restart the reactors? I think you'll have, you know, roving brownouts in Tokyo or something like that. I mean, those types of events which affect the average voter, I think are going to get the attention of the politicians and the utilities in Tokyo. You know, look, I'm actually surprised that uranium has fallen as much as it has. I think 60% of global production right now is not viable at $28 uranium. So that will change. You know, I'm not a believer that there are violent moves up or down with these industrial metals. Because of how they trade. They're usually traded on, you know, by handshake agreements and things like that with set prices. So, you know, you won't see a violent move higher or lower with uranium, but the uranium price has to increase, and it has to increase because the demand is there and the supply has contracted probably a little bit faster than certainly I anticipated.
Let's talk a little bit about food security and supply. What's your take there?
Again, that's another long-term trend that we're big believers in. You know, You've got a situation we talked about before with many more mouths to feed, both today and in the future. You have a situation where arable land, generally speaking, is decreasing. So you're going to need to find a way to increase the average yield on an acre or a hectare of land. And so that's where the potashes of the world and the phosphates and the nitrogens come into play. So I always sort of felt like the fertilizers never got the respect that some of the sexier metals like the lithiums got, but they're as important, if not more so, longer term.
Are you looking at any fertilizer companies or working with any of them? Yeah,
there's one in particular that we like, and we're consultants to them in the interest of full disclosure, is Uranium Resources. You know, this is a Quebec-based play. It's a high-grade igneous deposit, which is one of its main differentiators from its peers. You know, the supply of phos rock is dissipating. Most of the phosphate rock that's produced comes from, let's just say, less savory parts of the world, like for example Russia, we mentioned beforehand. So if you're looking for an opportunity in a, let's just say, a reliable, safe geopolitical jurisdiction to try and take advantage of a deposit that has very sound economics, there's also a bankable feasibility study out on it. You know, Arion is a very interesting opportunity.
What's your strategy of disruptive investing?
Sure. So, well, it kind of comes back to what I had talked about beforehand, where you have a situation in the, not just in the junior markets, but in, I would argue, in the commodity markets in general, where you have ample supply. You have an ample supply of labor, you have ample supply of capital and excess capacity, and cheap money sloshing around, all looking for a home. And the demand, just aggregate demand in general just is not there. You know, you've had the Federal Reserve in the United States pump $4.5 trillion into the economy, and the 10-year note, which is sort of the benchmark for growth and inflation, can't get above 2.5%. So, you know, we see deflation or disinflationary tendencies in the markets, and so that you have to think about what that does and doesn't mean with respect to commodities, and in particular junior investing. And we don't think, I call it throwing out the baby with the bathwater. We don't think running away from commodities at this point in time is wise. We think we're at the bottom. You know, if I knew when it was going to turn, I would, I'd be able to fund Elon Musk's Giga Factory because I'd be a wealthy guy. But no, so we think that if you're going to look at the junior space or even commodities in general, you want to find those companies that have some sort of a sustainable or an unfair disruptive competitive advantage.
Excellent. Well, Chris, it was a pleasure having you back on, and look forward to seeing you in the future.
Great. Appreciate it.